I don't know if you have heard the recent news on the increased capital gains tax exposure for real estate investors in Canada that was announced by the Liberal government in their budget of 2024. Well, they are getting a lot of slack for that. And I think that this could have some hidden consequences that they haven't really evaluated on how this is actually going to impact both the real estate investors and the housing market. So let's discuss. But first, you know the drill. Please hit the like, share, subscribe button and that bell icon. It gets me motivated to keep you up to date with everything real estate. Hi and hello, and thank you so much for tuning in. And if you are new, welcome to my channel. My name is Preeti Rao and I am both a real estate and a mortgage broker for close to 20 years. So for those of you who are unaware what capital gains really is, let me explain. In layman's terms, capital gains are profits that you earn from the sale of an investment, including investment properties. It's basically a tax that is imposed on any individual or a corporation when they part with the asset and gain a profit. Now, all this time, the calculation on the capital gains tax was fairly simple. Just follow the formula. You buy a property for a certain price, then you sell the property for a certain price. The amount that is earned from the sale of that asset, less all related costs, equals to your capital gains. Out of that, you are taxed on 50% of those gains. So let me back that up with an example. You sold an investment property and after paying all taxes and fees, you walk away with $100,000. You will pay the capital gain tax rate on $50,000 of that money. So basically $50,000 will be added on to your income for the year and you pay taxes based on that. Now, in order to know exactly what you're going to qualify for, I would seriously advise you to speak to an accountant because they know the best. But in today's video, it's all about the changes to this new tax that's come under the heading of tax fairness for every generation. And it's almost presented like a wealth tax because the headline clearly stated, budget of 2024 proposes an increase in taxes on capital gains on the wealthiest 0.13%. But I think that it's a little bit disingenuous for them to brand it as the top 0.13% because what they're saying is that only 54,000 Canadian actually sell an asset worth more than enough to realize a capital gain of more than $250,000 each year. But a capital gain event isn't really like an annual thing. So you can't really say it's the top 0.13% indefinitely. I think it kind of ignores probably the biggest problem, which is that there is so much pending capital gains in the market right now. And there are a lot of real estate investors who are just holding on to their real estate and they probably would or will eventually sell. Now, all of a sudden, they've been given a 3 months notice that the capital gain exposure that they have that is going to jump up substantially. And it is this entire debate, the percentages that are being thrown at us from all corners, from 1/2 to 2/3 on capital gains above $250,000 for individuals, taking the capital gains to 67%, and people are freaking out. I mean, I freaked out when I first heard that, till I sat and looked at the numbers and thought, okay, I think I can explain this and I think I can handle it. So let me break it down for you. And hopefully, it will help you make sense of what all this really means. So let's take a high income individual living in Ontario and earning a salary of $400,000. Salary, mind you, okay, he's not self-employed. Now, he also has an investment property that he sold, and after paying all the fees and the difference between what he bought to what he sold, he walks away with $300,000 in profits, which is now going to be considered part of the capital gains. Now, under the current rule, he will pay income tax on only 50%, that is around $150,000. In other words, this $150,000 will be added to his income and he will pay taxes on $550,000 for that year. But if he sells it after June of 2024, he will now pay tax only on $158,500 of that gain. How? Well, here it is. So he pays 50% on the first $250,000, which equals to $125,000. Then 67% on the remaining $50,000, which equals to around $33,500, taking his total capital gain tax to $158,500, and that is going to be added to his income for the year, taking his full income to $558,500, a difference of $8,500 as compared to the old calculation. Now, this will still continue to keep him on the highest marginal tax rate, and that would cost him roughly around $4,500 more in a combined federal and provincial income tax. Does not sound so bad now, does it, when you break it down like this? I know that a lot of people are not happy because all they heard was capital gains going up to 67%. That's not 100% true. So let's just hope that people don't panic and don't go to sell their homes before June 2024 just because they think that capital gains is going to be 67%. It's not. If you have had a profit of $250,000, the capital gains will be calculated at 50% of that. If you've earned anything more than $250,000, the difference is going to be at 67%. It doesn't break the bank as everyone else is talking. It's just the way they're calculating it. Is it a good thing? Is it a bad thing? That depends on what kind of an investor you are. But if you're walking away with a good chunk of change, I guess the argument is paying a little bit of taxes now. So you tell me what you think, and if you still don't know who I am, then just go check my rating on Google and read my client reviews. Till then, you take care. And if you found value or liked this video and would like to see more content, please click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Make sure to hit like, share, subscribe and that bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me because I hold the key that opens the door to your dream home.